As of Thursday, August 6, 2026 at 1:05 p.m. Eastern Time, Space Exploration Technologies Corp. is currently trading in the private secondary markets and shadow valuation desks at an estimated $137 per share, marking a flat intraday performance compared to the recent private tender pricing tiers that benchmark the company at a staggering $1.5 trillion valuation. While traditional equity exchanges display no live ticker for retail investors on standard screens, institutional desks and accredited platforms reflect a market capitalization that continues to defy conventional valuation models. Most retail observers looking at this asset believe they are evaluating a rocket manufacturer that occasionally launches internet satellites into low Earth orbit. The consensus story is straightforward: a dominant aerospace firm eating up government contracts and slowly expanding broadband access in rural areas. That consensus overlooks the true structural shift taking place beneath the surface. Behind the headline figures lies a business model engineered to capture near-monopolistic distribution rights over global orbital infrastructure. What looks on paper like a capital-intensive aerospace manufacturer is rapidly morphing into an asset-heavy telecom utility with gross margin potential that mirrors software platforms. The real engine driving secondary market demand is not the romantic vision of interplanetary transit, but the ruthless unit economics of low Earth orbit internet distribution. Investors looking at this entity through traditional aerospace metrics are measuring the wrong variables entirely. When you break down the recent secondary market dynamics, the institutional positioning becomes far more revealing. Over the past 3 months, private liquidity transactions have shifted from speculative venture funds taking profit to massive sovereign wealth and mega-cap asset managers accumulating positions. Trading volume across accredited secondary platforms has tightened significantly, signaling that current holders are unwilling to exit even at elevated multiples. While overall market sentiment in growth equity has fluctuated under persistent high interest rates and macroeconomic tightening, private bids for this stock have remained insulated from broader sector drawdowns. Institutional liquidity reports indicate that recent private tender offers were heavily oversubscribed. Large asset managers using accounts across self-investing platforms and individual brokerage setups routinely express frustration at the lack of direct access to primary shares, forcing them into secondary structures with strict accredited holding criteria. The appetite for exposure is driven by a stark reality in the launch ecosystem. Competitors are struggling with execution timelines, while this entity continues to increase its launch cadence quarter after quarter. To put the current secondary market price of $137 in proper perspective, one must look at how institutional desks are evaluating the capital allocation strategy. The market expected higher capital expenditure burn to drag down private valuations as next-generation launch systems undergone testing cycles. Reality showed that revenue generated from operational satellite internet services has begun offsetting a substantial portion of research and development costs. This operational self-sufficiency creates an economic moat that legacy defense contractors cannot match. Take a moment to write a quick response in the comments. Comment below how many shares of space or defense-related stocks you currently hold in your portfolio. Understanding how this economic machine operates requires separating its core business pillars. At its foundation, Space Exploration Technologies Corp. Operates as a vertically integrated aerospace and defense entity. The company builds, tests, and launches orbital-class rockets primarily through its Falcon 9 and Falcon Heavy family, alongside its next-generation Starship development program. Its customer portfolio spans government agencies like NASA and the United States Space Force, alongside commercial satellite operators across the globe. The core structural innovation that altered the industry's cost structure was vertical integration combined with partial vehicle reusability. By manufacturing the vast majority of engine components, avionics, and structural elements in-house, production overhead was drastically reduced. Re-landing first-stage rocket boosters transformed a historically single-use asset into a multi-flight capital tool, driving launch costs down per payload kilogram to levels that effectively undercut every global competitor. However, launch services alone do not justify a $1.5 trillion valuation target. The secondary revenue driver, which has quickly become the primary driver of top-line expansion, is Starlink, the low Earth orbit satellite broadband constellation. By leveraging its own launch capacity at marginal internal cost, the company deployed thousands of satellites to construct a global communications network. This dual capability enables subscriber acquisition costs and deployment speeds that independent satellite communications companies simply cannot duplicate. Looking back at past financial milestones, the trajectory becomes clear. In its earlier stages, the firm relied heavily on NASA development contracts, such as the Commercial Orbital Transportation Services Program, to fund rocket iterations. Those early government partnerships provided the non-dilutive capital necessary to prove out first-stage landings and cargo resupply capability. Once operational reliability was established, commercial launch volumes surged, laying the ground for internal cash flow generation. As we look toward the future outlook, the narrative surrounding Space Exploration Technologies Corp. will hinge on the execution of its heaviest launch architecture and the scaling of direct-to-cell satellite coverage. Expectations are that scaling massive deep space hardware will test financial limits and delay profitability timelines. If reality mirrors past execution cycles, successful orbital deployment of fully reusable heavy transport would reduce cost per ton metrics by another order of magnitude. That operational leap would unlock entirely new commercial markets, from orbital logistics to off-world manufacturing support. Furthermore, the expansion of satellite communication into mobile devices represents a massive potential catalyst. By partnering with telecom providers globally to offer direct cellular connectivity without specialized hardware, the total addressable market expands from rural residential broadband to billions of mobile subscribers worldwide. The downside risks, however, cannot be ignored. Regulatory hurdles surrounding orbital debris, spectrum allocation conflicts, and potential delays in major government contract execution remain persistent headwinds. When analyzing where this asset sits in the broader market context, the tension between expectation and reality remains the single most important framework. The market expects an aerospace entity bound by capital intensity and long hardware development cycles. The underlying reality reveals a high-margin connectivity giant that uses its own launch infrastructure to build an insurmountable moat in space-based infrastructure. Whether tracking secondary market pricing or preparing for an eventual public listing, investors who understand this fundamental operational advantage will see beyond the headline valuations and evaluate the real structural shift underway.